Welcome to Behavior and Risk, where we explore the intersection of decisions, the brain, uncertainty, and the business world. I'm John Burkhart.
And I'm Rich Loria.
We're glad you took a chance on us today. What if you could reduce the price of your car insurance? Do I have your attention? Nobody likes paying for insurance. Car insurance is something that's required by law for the most part, so it feels kind of like a tax. And nobody ever hopes to make an insurance claim, so it feels like a sort of useless expenditure. Consequently, most people tend to seek out the cheapest policy that they can find. Given all of that, it would seem like insurance providers should have a really easy time pulling in customers. Just reduce your rates lower than everybody else, and you should be able to corner the market. But we don't see this. And the reason is because of how risk products are priced. No underwriter can make an accurate prediction about what will happen to John Burkhart in 2025, but they can absolutely say, based on historical numbers and present conditions, we have extremely high confidence that there will be 351 total loss collisions among 47-year-old men driving Mazdas in 2025. And based on the expected payout per loss, they can arrive at a minimum revenue that the insurer needs in order to cover all of the 47-year-old males with Mazdas within their portfolio. This is a hugely oversimplified but conceptually correct summary of how risk products are priced. And indeed, we generally see that there aren't huge differences in policy prices from insurer to insurer because they're all performing the same basic underlying calculations. But wait, you are a good driver. How is it fair that you should have to pay more to account for the bad driving of other people in your bracket? Why can't they bring your rate down and just jack up the rates of all those other bad drivers? This is the premise that underlies telematic or usage-based insurance. UBI has existed in various forms since the late 70s, but it's just really taken off in the past few years due to advancements in technology that allow it to meet its full potential. Basically, when enrolled in a UBI program, either your smartphone or your car itself sends data back to your insurer about your actual on-road performance, and your insurance rate is adjusted accordingly. This is an actuary's dream because it allows them to update their risk models in near real time and price the risk far more accurately. It's great for safe drivers because it brings their premiums down to something far closer to a fair market price. It's a win-win all around, right? Maybe not. Despite the touted improvements that UBI offers, adoption has been slow, or at least slower than insurers would like. In many cases, insurers are seeing consumers dropping out of UBI programs after enrolling. What was originally believed to be the future industry standard for car insurance is now struggling. Not dying, but certainly not keeping up with traditional programs. So what's going on here? Rich, I find this area fascinating because it feels like this touches on every major topic that you and I have spoken about or presented on over the last 6 years. This is a fantastic confluence of risk, pricing, data modeling, and human behavior. And it feels to me like none of the involved parties fully understand the others.
Thank you, John. I'll just follow up a little bit that the UBI programs are really designed to reward policyholders for safe driving and to, in fact, encourage safer driving. And they provide the promise that policyholders can have more personalized and therefore cost-effective coverage alternatives to choose from. In theory, as you pointed out, this should be a win-win for every stakeholder involved. Drivers should be motivated to drive more safely because they will have lower insurance costs. And as you said, insurance is one of those things that because it is mandated, it feels like a tax. So anything that reduces taxes is always popular with the general public. Insurers should also benefit because they're going to understand the risks that they write better, because the information they will be collecting should, in theory, directly correlate with the risks that they're insuring. This should, in turn, allow them to better price the coverage, resulting in higher profitability and less volatile results. Regulators and government officials should benefit from the fact that there are reduced accidents, which will require less public resources to monitor driving habits and respond to crisis. And as a whole, society should benefit from a safer environment. So it really does beg the question of where the resistance is coming from. And maybe more importantly, why it's happening. Some of that resistance is due to data privacy concerns. Some is driven by disappointment in the amount of resulting discount that occurs when someone selects a policy. For others, yet, it just comes down to no one feels comfortable with having their driving habits monitored. Maybe it restricts their freedom, or perhaps drivers perceive it as even being difficult to change habits, or perhaps even unnecessary. Yes, my driving is good. It's the next person's habits that are poor. Therefore, as you pointed out, the industry continues to struggle to gain traction with this coverage, which has been viewed for a number of years as the future of the auto insurance industry. The number of those with UBI is expected to reach close to about 70 million by next year. And there are some sectors where they have had significant success, including in particular among younger and safer drivers. Nevertheless, for those that have really gone all in, it involves a major investment, significant sunk costs, and challenges in terms of data management, regulatory compliance, cybersecurity, and maintaining customer satisfaction.
I think part of the reason that there is this curious set of observations around how consumers are adopting and utilizing use-based insurance or telematic insurance is because it is a very easy sell, both on paper and in practice. Telematics sells because, depending on which study you listen to, there's anywhere from 70 to 96% of drivers who report that they are above average drivers, that they are better than the average driver out there on the road. And under 1% of drivers report themselves as being worse than average. Now, clearly there's some mathematical problems here. Statistics don't really work that way. I found one particular study I thought was very entertaining where 80% of individuals reported themselves to be better than the average driver, despite the fact that every one of them had been injured in an accident at some point in their lives. We talk about overconfidence and optimism bias in all manner of different domains of human endeavor. I think this is a very powerful illustration of both. As drivers, we think that everything is going to be okay. We think that we are good. We only have this car insurance because we're obligated to. We don't actually need it. And so, for that sort of mentality, I think telematics is a very easy pitch. Hey, guess what? If you're a good driver, your rate's going to come down. And I mean, we all believe that we're good drivers. And this also interacts with our perceived need for fairness. If we genuinely believe that we are above average drivers, well, then it's just not fair that we have to pay as much as everybody else. So the structure of telematic insurance really scratches a perfect itch people have around, I don't like paying for this. I shouldn't have to pay as much as everybody else. Hey, this shape of program is perfectly designed for someone like me. And I think that in particular, when you look at the fact that over the last anywhere from 3 to 5 years, insurance rates have been climbing quite substantially. I've seen different numbers, anywhere from 7% to 20% year over year on average premiums. Then yeah, I think it's very easy to see why people would be looking for any kind of discount that they could find.
I agree, John. Those are all good points, particularly about some of the trends in pricing in the industry in recent years. It's a chronic problem. I see it in my rates. Yet I'm not running out and getting UBI. I'll be candid for our audience here. It's not like I'm sitting there saying, I can't wait to put a device in my car and have it monitor what I do and confirm my already firm belief that I am better than an average driver. But I think this gets to some of the markets where they have had some success. So I mentioned earlier about significant penetration with younger drivers. So let's start there because auto insurance rates tend to decrease as one gets older, at least up until sometime around the age of 60 or thereabouts. But I remember when I was in my early 20s and I would get the auto insurance bill, I'd be like, oh my God, how am I going to pay this? So this is something that I think is a very easy sell to younger drivers who are looking for anything to reduce their bill, especially at that stage of life. This may be a significant part of what they're using with their income, whatever income they are getting, probably a very high percentage of it. So therefore, they've gained traction there. And I would imagine because the starting premium is higher, the potential for savings is much more significant.
And I think it's interesting that this particular younger demographic demonstrates something that is common across most of the domains we've discussed, which is decreased concerns about privacy in general. Younger drivers, younger individuals just don't care about privacy to nearly the same extent that you or I do. And concerns about privacy is one of the major barriers to uptake of telematic or UBI insurance policies. So again, we have a really nice convergence here of people who do have a pretty profound imperative to find any means they can to reduce their rates and who generally are not worried about really the major upfront drawback as people tend to perceive it.
That's true, John. And I would also point out that older folks are probably a bit more set in their ways. So there's more inertia that's set in. I look at myself and say, I've been doing this for a long time. I've been driving since I was 18. And I don't think I need some device telling me how I should brake my car, right? How I should hit the brakes on my car. I don't think I should have some machine advising me how to take a turn here or there. I've been doing that for a very long time. And as you go through life and as you develop habits, if those habits haven't killed you, then you probably have a confirmation that, yeah, what I'm doing works.
I would agree with every bit of that. It's absolutely true that there is greater cognitive inflexibility in general as people get older, and this manifests in any number of different ways. One of the biggest is the further entrenchment of established habits. In the States, where I believe we begin licensed driving as young as, possibly younger than any other developed nation, then we're looking at 40 plus years of habits around driving that such individuals may have. And these are also sort of the opposite of that younger population, the demographic that is most concerned about privacy, the demographic that is most reluctant to say, sure, I'll share where I am, how I'm driving, what I'm doing, how much maintenance I've done to my car. These are things that within older demographics, and I'm not quite that old myself, but I absolutely am a member of that conceptually. Why does anybody else need to know this? This is not their business. So, yeah, much like you, I'm not a telematic adopter. I think it probably is important that we be fully transparent with our audiences as we present this, that neither you nor I have bought in, neither you nor I have any intention really of buying in, unless there's some sort of major structural reform, which is either around privacy guarantees or, hey, guess what? We can reduce your premium by 70%. Something like that then I'd have to actually give it some consideration. But the average premium, especially for somebody who is in middle age or older, who is in their theoretically on aggregate peak income earning years, an average of $100 to $200 a year in savings, it's really not enough to make me change that habit.
Right. So this gets to the context of a particular discount that's being offered or not, and the framing of it relative to the total amount of assets. So when I think about it, and I would posit that this is probably a lot of folks in my peer group, in my generation, that the risk, the underlying risk appetite around data privacy or somebody getting access to some data that could in some way theoretically get into other assets that I have is much more scary to me than paying a couple of $100 more a year on my car insurance. I'll live with that. I'd rather keep as much information to myself to protect what I've already earned over the course of my career than be able to save a little bit here or a little bit there.
And I am wholly in agreement with that as well. My risk calculation basically is exactly the same. But to your point, that probably would have been different in my early 20s where my income was considerably lower. And well, that was really the only major change was my income was considerably lower and I probably was considerably more attractive, but it usually does not have a whole lot to do with auto insurance premiums. So you mentioned that there is that success among this particular demographic of younger drivers. I know that another demographic where telematic insurance providers have found success is among drivers who are genuinely better than average. Not those who believe themselves to be better than average, but those whose on-road performance indicates they genuinely are safe drivers. And I think this is really interesting because this is on average, not younger drivers. Younger drivers generally are not the best because of lack of practice and lack of experience and changes in risk appetite as one gets older. And yet, those drivers who are genuinely good have a much greater tendency to select and stick with these telematic insurance policies. And my suspicion here is that this is because these individuals, A, are getting a meaningful discount from their premiums, and B, they're getting what they signed up for. And I think that's a very important point that I want to come back to in greater detail when we start talking about drop off rather than successes and failures and uptake. But I think that this is another sort of demographic that is uniquely positioned to be drawn into a telematic policy and not be driven away from it once they've selected it.
That's true. I think those who are genuinely very good drivers with an extensively positive driving record, I think those folks are going to have some interest in this, even if they are somewhat older. They're probably going to be open to this and say, wow, I've been doing all this driving. I've put all these miles on my cars, and I've gotten a little bit of credit for it because it's not as if the non-UBI policies won't recognize that. Many of them have some type of good driver discount. I know my insurer has like a 5-year good driver discount. If you don't get into an accident for 5 years, you get some type of discount on your policy. But it's not what you could get from a telematics policy. So I think that the amount of benefit may be enough for those folks that it's worth for them giving a shot. And then to your other point about once you see the discount, if that discount lines up with what you already prospectively endowed, then you'll probably be more likely to keep the policy once you enter it.
And that's a really important term, that endowment of value. And I think this does lead naturally into the challenge that I think right now the biggest challenge that telematic providers are facing, which is drop off after individuals have signed up. And based on what I've seen, and I mentioned that I think that there's a big failure on the part of both of the major parties here, the insurers and the drivers, to understand where the other one is coming from. And that's leading to a lot of this. I think that there's a huge prediction error that occurs. I'm looking at one in particular. Allstate Insurance advertises the highest potential discount of all telematic insurance providers. They say you can save up to 40%. Okay, this is a bit of legalese. Yes, you probably can save up to 40%, but in practice, we know that that's not going to be the case for most people. In fact, the majority of people are probably going to be substantially lower than that. The numbers I have in front of me show that 72% of telematics consumers saved at least $100 on their premiums, with 21% saving over $300 per year. This is not 40% off of your automotive policy, unless you're driving a 1972 Pinto. Well, that's probably not a great example, but you're not saving 40%. But by saying you can save up to 40%, a prospective consumer is hearing you will save 40%. And so even if they do receive some discount, even if they receive a 20% discount in their premium, in their head, they've already received a 40% discount. And so this to them is actually a 20% increase. And yes, I know percentages don't actually work forwards and backwards that same way, but you know what I'm getting at, that they've actually gotten an increase in what they believe their insurance premium will be. This is phenomenally aversive. This directly impacts dopamine levels in the brain. And this tells people, hey, that thing that I just did, sign up for that program, I shouldn't do that. I should back out of this program now.
It feels like a bait and switch.
It absolutely does. And correctly or not, insurance providers right now very much are seen as villains in the United States. I can't speak to globally, but insurance providers do not have a good reputation right now. And these kinds of things that seem like bait and switch tactics produce substantial reactance against the insurers themselves.
Well, the idea of insurance companies as villains is nothing new. This is just a new form of it. This is just more cognitive evidence that the general buying public will see against them, particularly because we're talking about a kind of insurance that's mandatory, that feels like, okay, if I'm going to have a car, I've got to pay some of my money to these folks who I'm somewhat suspicious about to begin with. So this idea of, oh, you can get up to 40% or whatever the number is, but then say maybe you only get 10%, 15%, whatever the number is, it's significantly less than what was put out there as a cap, and it was represented as a cap. So I want to be very clear. We're not in any way saying that insurance companies are being deceptive, that they are saying something that is a false claim, because there are probably a small minority, but there's probably at least a good number of policy holders that do get that maximum advertised amount. But the fact that there are so many that don't, the anchoring effect comes into play here, as well as, again, a certain endowment that, yes, I'm going to drive safe and my insurance costs are going to go down 40%. That's the general thinking. That's, even if it's not a conscious thought, that is what is being perceived. That is what is being taken in through the advertising, which, again, I understand from the industry standpoint is a way to try to get folks to move into this. So one thing I was thinking about, and I'm going to take the liberty here in this podcast, I don't know if this humor will fall flat or not. As you were talking about this whole phenomenon of anchoring and prospective endowment, I was thinking about those old Wendy's commercials. If you remember, the little old lady from the Wendy's commercial would say, "Where's the beef?" And that's how I think it feels to some of these customers. It's basically the equivalent of, "Where's the beef? Where's the discount?"
I don't want to admit that I know exactly what you're talking about, and I can hear her voice in my head as you mention that. But yes, I think that's absolutely correct. It's a mismatch between expectations and observed outcomes. And this mismatch, or in the behavioral neuroscience space, we call it this prediction error, is a direct mechanism of how we learn what not to do, how we learn to avoid things. And so when a customer does experience this, where they have justified or not an expectation that they're going to receive a 40% discount, and let us emphasize, this 40% number is for one insurer. Most are not advertising that, but nevertheless, a large insurance discount and you get a 10% discount, it feels as though you've gotten nothing at all. And this is telling your brain directly, hey, this was a bad idea. We shouldn't have done this.
Yeah, you start to get into that whole regret type of feeling. And that's something that none of us wants to feel because, as you pointed out, from a biochemical standpoint, the dopamine levels get significantly reduced. And we're going to do whatever it takes to avoid that kind of feeling.
And it's something I mentioned. I do want to clarify very specifically what I mean, that I think this comes from a lack of understanding bidirectionally between the consumers and the insurance providers. Consumers perceive insurers as greedy, money grubbing individuals who are just trying to nickel and dime every last red cent they can get from the consumers. And this is just another mechanism for them to do that without the consumer realizing what's being done to them. I don't think that isn't, in fact, what is going on. I know actuaries, and this is the sort of granular data that they love. This makes their job much easier. It introduces more data for them to process, but it makes it much more easy for them to land at accurate pricing of risk for individuals, which historically is very difficult to accurately price. And on aggregate, I think it makes the risk managers' lives at an insurance company much easier because now because you have better pricing, you can have a stability in terms of what's the total output or expenditure you're going to have to make in any given year, and you can plan accordingly and make sure that you have the available assets or the available reinsurance so that you're not going to be stuck in a bad position. So I get that. But I think the insurers themselves are also not understanding why consumers buy car insurance. I mean, yes, they buy car insurance because there's a regulatory obligation to do so. But insurance's value proposition, every type of insurance's value proposition, is the reduction of uncertainty. That's what consumers get from insurance. Consumers are not buying this because they're going to get great coverage when they file a claim. Consumers are not thinking about filing claims when they buy any kind of insurance. That's just not how our brains are wired. Literally, the only benefit that consumers receive from a policy is the reduction of uncertainty in their future. We know that humans don't like uncertainty. We avoid uncertainty wherever we possibly can. And telematic insurance eliminates that. It's introducing variability into a product that, by its nature, is supposed to stabilize things. So it's something that when you're shopping, I think it can appear very appealing. Hey, lower rate for the same compliance requirement that I have, fantastic. I'm going to do that. But even if you do get a reduction in rate, the fact that you don't know what you're going to get, and depending on how frequently they update, your premiums may change quarterly. They may change every 6 months. You don't really have any ability to predict or budget out accurately month to month, year to year, what your finances are going to look like. To me, this will be extremely aversive.
What you pointed out is the whole black box impact of this product or aspect of this product, which I think is very much aversive to many consumers. We like to have as much knowledge, as much certainty, knowing if I do X, Y, and Z, this is what's going to happen to my rate. And you don't really know that. You have some idea, you have some rough gauge of what it is. The insurance companies are transparent about the types of behaviors that could potentially result in a reduction in premium rate. But it's not exactly clear how that goes through their algorithms, which again goes back to the actuaries. I'm sure there's a lot of data analysis supporting how this is all done, but I'm also sure there are margins and there are other shock absorbers, so to speak, put into place by actuaries to make sure that they're not overstating one way or the other. So, John, the other thing which you alluded to that I want to talk about a bit, and certainly in my 30 plus years in the insurance industry, this is something that I saw again and again, is that shifting risk to the insureds, particularly in the retail marketplace, is a tricky thing to do. And it's not always popular for exactly the reasons that you stated, that since you're shifting risk to the insured, that in effect, they are coming closer to self-insuring, which then begs the question, why do you have the product in the first place? So you really do get to a place of what's the value proposition from the insured standpoint if effectively I'm going to be paying for my driving habits.
And I think it's very important to point out with this that we're talking entirely about perceived risk, not actual shifting of risk. And I think that's also part of where consumers and insurers maybe are talking past each other or not fully getting where the other is coming from, because this is something that you and I have seen in the class that we teach all the time. Risk management students are really not the best for doing illustrations of cognitive fallacies on economics decisions because they're conditioned to be very quantitative and not fall prey to these emotional or pre-conscious heuristics that people tend to fall into. And so if you tell an actuary, well, people are not going to want this sort of policy because they're going to believe that you're putting the risk on them, the actuary's response in general is going to be, but that's insane. That's not correct at all. They're still getting a reduction in risk. That's just dumb. I'm exaggerating, of course, a bit, but it is a sort of general tendency that people in this space, and I don't want to single out actuaries, anybody who works with money and numbers for a living is going to have this sort of response to this kind of human response. Whereas the consumers, genuinely perceive that they are having risk put onto them. They genuinely believe that both the risk and their expenditures are being increased and they're not really getting anything in return. And so it's important that I think that we really recognize that there is this difference between actual shifting of risk and perceived shifting of risk. Because I don't think there is a real actual shift of risk, but people believe that there is. And the perception or belief creates these very challenging market dynamics with consumers and insurers.
Those are great points, John. Yeah, it is a matter of perception versus reality. The shifting of risks, so to speak, to the degree there is any real shifting of risk, is just in terms of the time lag between the actual driving performance and how that gets reflected in the rate. And to me, that's relatively minor because it's not as if the policyholder is having a reduction in limits or that if they suddenly start to drive more poorly, that if they do wind up with a claim, that that claim is going to be massively reduced from what it would have been had they had a better driving record. So I just want to be clear for our audience, just to put it in a little bit more tangible specifics as to what's actually going on, that it's more of a pricing risk that's being shifted and not the actual claims risk itself.
Now, you said something that I found really interesting there. That is the possibility that somebody suddenly starts driving much more poorly. In practice, what is seen is that people who do take up telematic or UBI policies tend to drive better when they do select them and stick with them. And it's been put forward that really this is the true value proposition of telematic insurance. The, for lack of a better term, behavioral engineering that occurs around people's driving habits. In addition to increasing auto insurance rates over the last 3 to 5 years, there have been increases in accident rates, in percentages of total loss collisions, and in instances of severity of injury from resulting from auto accidents over the last basically since COVID. And this telematic approach is seen as potentially maybe the best tool, the best carrot available to try to get people to drive more safely. Now, I have mixed feelings about this because this aspiration is, I think, worthy. I think that having a safer driving environment is to the benefit of everybody. But, and I know this sounds kind of curious coming from somebody who makes his living in the applied behavior space, this kind of behavioral engineering at scale, it makes me raise my eyebrows. And particularly when you have an instance where insurers really are perceived to be villains for the most part, I think that attempts to convert behavior at scale are very likely to end up producing reactance, that is to say, a visceral pushback rather than compliance, a spontaneous assertion of autonomy. You're not in control of me, I'm in control of me, even if it is to the detriment of the individual, in this case, the consumer. I don't know. That was more just a rumination, I think, than a particular conclusion. But I do think that the behavioral engineering element of telematic insurance is something that we can't neglect and needs to be considered in terms of how should this be done? How can it ethically be done? And how is this impacting uptake and drop-off rates for such policies?
Yeah, there was a lot packed in that, John. So I'm going to try to unpack some of it as carefully and as cautiously as I can here in the next couple of minutes. First off, I do want to comment. One of the things I found very interesting about telematics and UBI in general in this space is something that is very counter to what you see in most lines of insurance. And you referred to it as individuals get used to the UBI, assuming that they stick with it, assuming that they're comfortable with their telematics device and that they continue to stick with the coverage, their driving habits over time get better on average, and often pretty significantly. This is something that is very different than what we see in most types of insurance, where in many, especially where insurance is initially underwritten, where the insurance company gathers information and evaluates the risk and prices it accordingly. In the insurance, and what tends to happen with risks over time is that in a typical insurance product, let's take a life insurance product as a comparison. So let's say you go in, John, you're in your late 40s, you buy a $500,000 life insurance policy, and you go in, you give blood, you give other information about yourself, you get a physical, all that sort of thing. That's when the insurance company knows the most about your health and has the best assessment of your risk. Now, over time, that's going to quote unquote wear off. That information will become more and more stale. And therefore, their assessment of the risk, not just you, but all of those in your cohort, is going to be less accurate. And the actual mortality experience will worsen, not only because of the age, but also because the underwriting itself wears off. And I learned in actuary school, and I still think it's applicable today, even though I went to actuary school almost 40 years ago, that's referred to as select and ultimate. So we selected you, and therefore, when you were selected under underwriting, that's when you provide the best experience. Over time, you start to merge into the ultimate pool of overall population mortality. That's counter to what's going on here with UBI, which I just think is so fascinating. And why, in some cases, I find myself drawn to maybe go out and change my mind about it. Because I love this idea of a reverse select and ultimate, where at the beginning, the insurer doesn't know anything about your driving habits. You put the device in, that's when they have the least information. But over time, as you drive, they gather more information. They provide a feedback loop about what you're doing well, what you're not doing well, in terms of both ongoing information as well as, of course, your renewal rates. And that over time, these things tend to nudge drivers on average to be better drivers than when they started. So that results in a reverse select and ultimate, moving them beyond and improving their performance relative to the average pool of drivers. So I just find that super fascinating.
I have a couple of responses to that. The first is you are such an actuary at heart that you actually just use the term mortality experience rather than death. And I find that amazing. Second is that, yeah, it's really impressive the fact that these programs are able to create such lasting conversion. Part of that, I think, is the direct and ongoing feedback, in contrast to, say, for example, life insurance policies or other sorts of personal insurance policies, where there may be annual check-ins, perhaps, but largely you have the upfront evaluation and then it's by the numbers for them there on out. With the telematics, in many of these programs, you get feedback in real time. You'll get a notification of, hey, that corner you just took, you're going a little too fast, or maybe don't slam on your brakes so fast. These are things where you can adjust in real time. And while I've not participated in such a program, I could absolutely see it being like being back in driver's ed and having that fear of the instructor sitting over there in the passenger seat and tisking you as you do something that you're not really supposed to do or not doing something as well as you should do. So I could see self-correcting. And if you participate long enough, absolutely this will result in habit formation. This will definitely result in a shift in how you perform automated tasks. And that's really what we're looking at here is the moment to moment discrete decisions. That's, I think, speaks to what you were talking about when you first come in to apply for a life insurance policy. You're making a volitional choice at every point along the way. But with driving, for the most part, once we are trained drivers, for lack of a better term, I don't know how well trained either of us is or how well trained the average American driver is, but we're no longer learning how to drive. We don't think through most of the decisions that we make while behind the wheel. If you were to ask me what was my sequence of thought in pulling out of my driveway, turning onto the feeder road out of my development, and then out onto the main road in front, I couldn't tell you. I could simply say, I did it. I turned the key and then I did it. And this kind of habit formation is powerful because it lingers, because once that habit is formed, it's not going away unless a different habit takes its place. And we've talked about this. That is the core of lasting behavior change. That's exactly how you do it. Now, the slightly, I won't say pernicious, but slightly concerning element, perhaps, that I see behind this is that ultimately, whether by design or not, and I don't know if this is in fact their goal, but I can say that this absolutely would maximize their profit. The ultimate outcome of this sort of corrective feedback is to reduce the amount that you drive, because that's the only way that you can guarantee that your rates go down and that you don't perform something that you shouldn't do. Because we've all heard the stories that even just slamming on your brakes is enough to pop up as a problematic event on your policy and increase your rate, even if you had nothing to do with it, even if it was because there was an accident in front of you and you had to avoid it. This is, of course, because insurers don't care whose fault it is. Simply the probability of an event happening, regardless of the fault, is all that they pay attention to. And so I could absolutely see myself just driving less and less and less if I had this kind of policy. Now, this is very much to the benefit of the insurer because they're collecting the same premium, but their exposure is massively decreased. But it means that I'm getting far less utility for the same amount of money. And I don't know where the balance is there. Maybe I'm just thinking this through too far to one extreme, to one outcome that probably is not going to be reached by most people, but it is something that I do find somewhat concerning.
I do think that is a concern, but I'm not sure what you can do about it other than to maybe place more weight on some of the other factors and maybe less weight or in some way normalize the amount of whatever the rate is to the actual usage so that those who drive more are not definitively punished more or have some sort of adjustment for volume driving in some way. I think there are ways to try to somewhat mitigate that. But again, if you are truly making this a coverage where it is priced based on the underlying risk, then de facto, the less you drive, the less risk you're taking. John, if you don't mind, I'd like to move to one other aspect of what we've been talking about here, which is the voluntary nature of telematics. So, in your opening to this podcast, you correctly pointed out that in many countries around the world, especially developed countries, auto insurance is mandatory. However, telematics is not. And as we've seen, particularly in the flood space, which we've talked about before, when you make a coverage voluntary versus mandatory does bring in certain things. So we've talked about the fact that a successful foray that the insurance industry has made is into those who drive safer to begin with. And so what that creates is, again, another selection effect with regards to UBI. And what I'm concerned about is what does that mean for everybody else? And are you going to wind up with escalating insurance costs outside of the UBI sphere? What does that mean in terms of affordability and so forth?
I think that depending on the will of the insurance providers themselves and what they see as their optimal long-term strategy, I could absolutely see a world in which traditional policies just get priced out of existence. They're still available, but the premiums are made higher and higher and higher so that even if your rate under UBI would go up, it's still more cost effective to take such a program. I get it from the point of view of the insurers, just because, again, you are basically by engaging in a traditional program, you are creating more obscurity around your own personal risk levels compared to UBI customers. And this is something that, I mean, in the risk space, if you undertake more risk, you have to be compensated. So
Mhm.
I get it as a business case. I don't personally like it because, as we've discussed, I don't want to take a UBI policy, but Yeah, I think that probably is something that could occur. I think much will depend on what does the regulatory environment look like. This
Mhm.
is something that potentially could be a political non-starter, and not because of any of the insurance elements of it, but because of some of the privacy concerns. Circling back to that, we discussed it and we dismissed it, but there are some very legitimate issues that have emerged around telematic insurance, which is misuse of driver data. That basically, yes, the insurance providers collect it, but there have been a handful of cases where it's then been sold to third parties. And the chain of custody and the awareness of what is then done with it is murky at best. And I could absolutely see this being something that politically is a non-starter and prevents the regulatory environment from arriving at a place where it's permitted to essentially gouge traditional policies out of existence.
Yeah, I think the regulators are going to keep a close eye on this. That's been one of the big resistance points, has been particularly with some of the bigger states here. There are data privacy concerns from some of the bigger state insurance departments, such as California and DFS here in New York, is why I think this idea of the insurance companies being allowed to price out non-UBI policies won't happen for the foreseeable future, at least as I see it.
Yeah, I would agree with that. And I am somewhat reassured by that, that political inertia and good old-fashioned backroom dealing probably will, for the foreseeable future, prevent that. Now, as insurance rates continue to climb, or if they continue to climb, I should say, if we do see a continuation of this anywhere from 7 to 20% year over year increase in auto premiums, then I could see a case where federal regulators basically say, hey, you guys got to do something. Do something to get this under control. And the insurers come forward and say, well, we've got this program in place that could help the things. That's maybe the one case where I could see that, yeah, the regulators would say, okay, you guys go ahead and do that.
Yeah, it's possible. It's definitely possible. The one thing I would say in response to that, and this is one of the big challenges right now, and it's an ongoing challenge for regulators in pretty much any industry, is that regulators tend to be behind the curve in terms of understanding new technologies, new approaches to product development. It's not just limited to the insurance industry, but certainly it is a challenge for regulators to keep up. And not all state insurance departments are created equal. New York and California have significant staffs, whereas other state insurance departments often have to rely on consultants and other third parties to deal with certain regulatory issues, such as rate reviews. So, as you can see, telematics offers a lot of opportunities, not only for the insurance industry, but for society at large, for perhaps a vision of a safer future. However, there's quite a bit of resistance, including from stakeholders that you would think would have self-interest in this, such as regulators, government officials, and others involved. However, there is one set of stakeholders we haven't mentioned, which are agents. Even today, quite a bit of insurance gets sold through agents, and the typical agent model is providing compensation to the agent as a percentage of commission. So, to the extent that rates go down because people drive safer, that takes money out of the agent pockets, which is why I think in some cases there has been some resistance in those quarters. And agents do still have quite a bit of influence over the direction of the industry. The fact that these ongoing conflicts are going on means that, in my mind anyway, there needs to be a structural reassessment of all aspects of auto insurance, from policy inception to claims and so forth. The whole thing needs to be reviewed and assessed. And certainly telematics can be a significant part of that revamping to make the coverage more accessible, more affordable, and provide greater customer satisfaction.
Behavior and Risk is brought to you by Capita Solutions. Behavior and Risk staff includes our research team, Sherry Xu and Jin Zhang, and our editing team, Jingying Gao and Athena Liu. Theme music by Crypt of Insomnia. The opinions presented here are solely those of John Burkhart and Rich Loria and do not represent those of Columbia University, Capita Solutions, or any other organization. We thank you for taking a chance on us today.